Next, let's talk about accrued expenses. When we see the word accrued, know that it means that there was no cash involved in the transaction prior. This just was simply something that maybe we didn't know we had to pay, or we just have not paid it as yet for the month. However, to go along with the matching principle, just because I didn't pay a bill, it doesn't mean that it shouldn't have been recorded. Think about it. We have liabilities that need to be recorded. Liabilities are accounts that show the balance I owe to somebody. And most times, that's a bill. And so if I have a bill that I haven't paid by the end of the month, but it's related to services performed during the month, maybe I used the water in the month of June, or maybe I got my grass cut in the month of June, but I didn't get the bill until July. It doesn't mean that I record the expense in July. I actually need to record the expense in June because that's when the work was done on behalf of the company. And so all of these instances are going to be related to things that were done within a specific month or within a specific period. And maybe we didn't get a bill, or maybe we have to estimate what the cost is so that we can record the cost in the proper month, which is the month of benefit. And so we're going to go through a number of these. These type of transaction accrued expenses normally involve a liability account and an expense account. When these things happen, we have to acknowledge that there is now a liability. I do now owe, whether it be a vendor or an employee. And because of that liability, I can also acknowledge the fact that there's a new expense that I incurred as well. I have done something to cause my business money. Okay. And so in these cases, the liability account is always increased and the expense account is always increased. And if you recall, an expense account is increased with a debit, a liability account is increased with a credit. So that means in all of these instances, we should be debiting an expense account, crediting a liability account. Let's see the questions. It says on June 30th, 2023, a utilities bill of $300 was incurred, but has not yet been paid, meaning that I used the utilities, but I just haven't received the bill and I haven't paid it yet. I'm going to pay it after June 30th, but I used the utilities during the month of June. So therefore, in this case, at the end of June, June 30th, I have to record an entry to add this $300 worth of liability and expense to my books. And so as a result of that, I'm going to debit, like I said, the expense account. So utilities expense is going to be debited for $300. And we have utilities payable, or in this case, you can use accounts payable. That's fine as well too. Once it's a payable account, for saying $300. And that's it. Debit the expense, credit the liability. Let's look at the second one. June 30th on a Thursday is on a Thursday, and the company pays its employees every Friday. The business has 3 employees each earning $1,000 for a 5-day work period. What this is saying, and this is a perfect example of cutting off or things falling within a different period that we're paying for later. And so this is referring to employee salaries. Employees aren't always paid on the end of the month so that their salaries for the full month are recorded in that month. Sometimes the payment comes later. And so in this case, they're saying that June 30th is on a Thursday, but this employee is going to get paid on a Friday. And they're getting paid on Friday for the past 5 days. So that means the Friday pay most likely was for Monday, Tuesday, Wednesday, Thursday, and Friday. Friday represents a new month, July 1st. So therefore, when we record the payment actually made on July 1st, that means if we were to put the full amount of their pay in July 1st, we would actually include some of the days from June that spilled over into that pay period. So Monday, Tuesday, Wednesday, and Thursday, because Thursday is the last day of June, these 4 days were actually related to June and should be posted in June and not July 1st when the payment is made. And so that means I need to prepare an entry then for the last day of June, June 30th. I'm going to record the portion of the payroll for that week that relates to June only. The portion for July, I don't have to worry about that. I will record that in July. But I'm only concerned about adjusting my payroll expense and my payroll or my wages payable for the 4 days in June that were not recorded. And so therefore, if I wanted to calculate the amount, because they tell us $1,000, but they said, first of all, we have 3 employees and each of them earn $1,000 for those 5 days. So my first thing I need to identify is if I need to find out their pay for 4 days, I need to take $1,000 divided by 5, which is a 5-day workday. They get paid $200 each per day. For one employee, I can take that $200 a day times the 4 days that represents the last 4 days in June. That's $800. So as of June 30th, I owe each of my staff $800 for the rest of their June pay. I can't stop there because I have 3 employees. This $800 is only for one. So 800 times 3 gives me $2,400. $2,400 is what I need to add to my expense as the pay for the rest of June. And so again, I'm debiting an expense account. So I'll call it wages payable. Sorry, wages expense for $2,400. And as I started to say ahead of myself, wages payable would be my credit for $2,400. So it doesn't matter how the calculation is. Sometimes they can actually calculate some things differently. At the end of the day, we're still going to debit an expense, credit a payable. As you can see, we did it the first time. We're doing it a second time again. The third one says, as of June 30th, 2024, rent expense of $1,500 has been incurred but remains unpaid. Incurred means that it should be an expense, but we just haven't paid it yet. And so therefore, we have to record it as an expense and that it's payable as of June 30th. So now let's put this in. Let's change this date to June 30th. Again, an expense is debited and a liability is credited. So I can say rent expense, rent expense credited for the $1,500. And I can say rent payable, or I can say accounts payable, whichever, for $1,500. Most of the times we use accounts payable when it's like your normal business activities. Sometimes some things are unusual, but something like paying rent is something that's normal. Wages, we always separate from accounts payable. So whenever we have staff issues go to a wages payable account. Okay. But that would be my entry in this case. When I look at the 13th, the company has a 5-year lease agreement for office space with annual payments of $4,800 due each January. In this instance, this is actually, looks like this may be in the wrong space, but you should know that this isn't an accrued expense. This is going to be a deferred expense because they're referring to the fact that in January, they would have paid $48,000, but that $48,000 is an annual payment. So it's for more than 1 month. It's for 12 months. And so if they would have paid this in advance, this would be considered a prepayment. And so we would have posted this to prepaid rent. And then we would have figured out, okay, If we prepaid rent every month, I would take the 48,000. That's an annual payment divided by 12. 4,000 would be my expense every month. Okay. That would be how I would look at this transaction if I had prepaid it. But let's say we haven't prepaid it yet and we're paying it on a monthly basis. This particular month at December 31st, maybe we haven't yet paid for the month of December. What happens now is I need to accrue the rent expense. And so in this case, the same thing will happen here, because if it's a lease agreement for an office space, all of that is still rent. And so the amount would be now 4,000, which is the annual amount that I'm supposed to pay divided by 12. So on a monthly basis, I'm supposed to pay $4,000 each month. And that's how we could look at this question to fit underneath the accrued expenses category. Again, expense debited, payable, credited. This one here says the company has a loan of $30,000 at an annual interest rate of 15%. And what we're going to do is we're going to assume that we need to record the interest because maybe we haven't paid the interest as yet. And so normally when you see interest rates given, 15%, this represents 15% for the entire year. Interest is normally calculated by principal times time times rate. And so this is the principal, the amount that I have to pay back. The time is annual, so that means each month I should be recording 1 month's worth of interest, and the rate or the percentage is 15%. And so if I wanted to figure out how much my interest is, let's say I'm trying to figure out my interest expense for the month of December, this is using simple interest in this case, a simple aspect of it. I would take the 30,000, multiply it by the rate, 15%, 15%, 0.15. For the year, that means this is the total amount of interest I would be paying. If I wanted to find out on a monthly basis, then of course that means I would have to divide that by 12 and I would get $375. So $375 per month would be the interest amount that I need to pay. And so therefore, following the same premise, expense and a payable, I would be recording this to interest expense for $375. And I could use interest payable. This is definitely non-accounts payable issue, $375. And so whenever you see questions talking about interest rates and they're giving you these rates and these principal amounts, it's because they want you to determine what's the interest amount to be allocated to each month's interest expense. The final one is another payroll related question. They talk about commission in this one. So staff earns commission of 10% of revenue. Some people, that's how they get paid. They don't get paid a certain amount per week. They get paid a certain amount based on something. In this case, 10% of revenue is what the staff is going to get as commission. And commission is another form of payment to staff. Normally it goes to a commissions expense and a commissions payable type of account. And so it says during June, the sales were $450,000. Payments are made in the following month. So that means that commission for the sales in June is going to be paid out in July. But we can't record commission expense in July based on June's numbers. We have to use June's numbers and calculate how much commission is owed as a result of these sales. And so in this case, $450,000 is my sales times 10%, so 0.1. That means that $45,000 is how much commission is going to be paid in July, but that's the amount of the commission that's supposed to be paid in June, as of the end of June, or is owed at the end of June. So that means my entry is going to be June 30th, and I'm going to record commission expense for $45,000. And again, commission payable for $45,000. Okay. So you saw on each of the examples, when I go back and I look at it, all of my answers come back with a debit to an expense, a credit to a payable. Debit expense, credit payable, expense payable, expense payable, expense payable, expense payable, expense payable. This should always be the case when we are accruing something. And so sometimes the hardest part of these type of questions is just figuring out the amount that I'm going to accrue. If it's a monthly amount and I'm recording the entry at the end of the month, then we already know what it is. Sometimes they give us calculations. We have to figure out how much, for example, how much payroll is left for the month. And we just have to look at when was payday and how much days were they paid for that related to another month. And so we have to separate. If it's 5-day pay week, there's 4 that relates to June and 1 that relates to January to July. And so therefore, we need to estimate or calculate how much of the pay that they're going to receive in July is related to June and record the June expense in June, not recording it in July when the payment is made. Then we may have instances with interest. They give us principals and percentages. We just have to calculate how much the interest expense is for each month. And then we would post the interest expense and the interest payable. Same thing with commission, payroll based on something. At the end of June, they're entitled to 10% of this 450,000. So therefore, we should record it as a liability. Commissions payable, and we should record the expense. And so this is one of the straightforward aspects of recording adjusting entries, debit, expense, and a credit to a liability.